Hey, everybody, welcome to This Week in Pre-IPO Stocks podcast. With me, I got Clint Sorensen, Chief Investment Officer at Wells Shield, an outsourced CIO and investment research company, Evan Cohen, co-founder and Chief Operating Officer of WithVincent.com. It's a media company focused on alternative investments, and Nick Fusco, CEO of 8View, a pre-IPO secondary market pricing company. All right, fellas, I watched a podcast with the CEO of FigureAI yesterday, and I love this company now, right? And the CEO is great. So here's the thing. Here's the kind of the topic I want to talk about with you guys. So I think, this AI, we know AI is coming. Humanoid robots are coming. It's going to drive a massive amount of efficiency. This guy, the FigureAI CEO, said good costs of goods and services are going to drive to zero. And there's unlimited upside GDP potential because you're going to have, he said, 10 billion humanoid robots by 2040 on the planet. 2040. Okay, that's 16 years from now. That's not far. Elon Musk said that he's projecting 16 to 32 billion humanoid robots. I checked it out, right? And of course, he's got Tesla Optimus, which is their humanoid robot. So Figure just raised $675 million at a $2.6 billion secondary market valuation. They had OpenAI, Microsoft, and Nvidia as investors in that round, right? So maybe Nick, we'll start with you, man. Like, what are you hearing from Figure kind of in the secondary market? What do you think about humanoid robots, right?
Sure. So we chatted on the humanoid robot piece. I'm going to start there. I'm not going to poo-poo it. Sounds great, but those numbers sound nuts. And I forget what number podcast it was from us. I compared it to, okay, how many people have iPads and how many people have Tesla cars? Maybe the number or count might be somewhere in the middle for the robots. Mm-hmm. But secondary market data on this is suggesting people are bullish. The amount of bid offer that's going through on this is growing, and it's substantially leaning towards the bid side, which is usually a really positive notion. And just in the last, like 5-6 months since that round, you're seeing a dramatic increase in the valuation set by the secondary market itself. So you're really up around like not 2.6, but a 2.9. So whether those numbers are coming through or not on the head count or whatever we want to call the robot count, the market is reflecting this as a 12.5% increase on the round.
Right. That's very interesting. Okay, so Evan, I know you're like a hard no on humanoid robots. You've said that multiple times, right?
But he's just scared though. He saw Terminator 2, RoboCop. He's seen it.
But you've had direct experience in manufacturing like physical products, right? So like, I guess my question to you is, these guys are saying that humanoid robots are ideal because they can kind of work inside of a human system, right? Like, the whole world is obviously built around human beings, right? Our world, at least, is built around human beings. And if you make a humanoid robot, it can like naturally fit into that, whatever the application might be. That was the argument, because he specifically talked about that for 10 minutes. Is the FigureAI? How do you respond to that? Like, what do you think?
I think that the reason why the world is built around humans is because we are humans and the world is built around us. But I would also say that if you were trying to perfect the human body to be optimized for certain tasks, it probably wouldn't look like us. It would probably have a number of different configuration sizes, maybe different extremities, probably dozens of hands, dozens of arms, much taller, leaner, faster. And so, as I said before in previous podcasts, the concept of a humanoid robot assumes that the human body is like a perfect optimized tool, which it really isn't in a lot of ways, and it doesn't make a lot of sense. I also, the valuation 2.6, whether it's 2.6 or 2.9, it just feels incredibly high for a product that does not have product market fit, does not have like a massive list of customers who are willing to purchase it, does not have a demonstrated view of efficiency. It kind of reminds me a lot of I don't know if you guys remember in 2014, 2015, a company called Magic Leap, where people were really, they were very bullish on VR. They were bullish on the concept of, hey, virtual reality, augmented reality is the future. You have a company that's a leading member in the technology side of things. They're developing really things that are impressive. What happened? They burned billions of dollars, never actually even brought a product to market. And so it feels a lot more like that to me than it does a product that, yes, the idea of robotics and that makes a lot of sense, but in practice, we haven't seen it. And I think this is a lot of money to go to something that we haven't seen.
That's prudent. That's a prudent take. So Clint, maybe let me ask you this, man. Like, if these guys, so Evan's not wrong, right? Like, this is a very new idea, and it could take a really long time to play out. But assuming that these guys are half right, so they don't have 10 billion, humanoid robots by 2040, but there's 5 billion. I mean, there's 8 billion people on the planet. I mean, that's a huge change. That's a huge change. It's going to probably impact, economics and whatnot. I mean, what's your kind of take on that as an investor? Is this interesting right now? Do you think it needs to kind of mature a little bit more? Like, what's your take on that?
So, I look at it from a trade perspective. There's positive sentiment, increasing sentiment. There's a positive trend, obviously, in robotics in general and AI. So I like those themes. Those, from a trade perspective. Problem is, to Evan's point, the use case, the valuation, the the humanoid robot thing bothers me. I'd rather see expert systems developed and deployed in hardware that fits the use case and increases yield and increases efficiency versus just because it looks like a human.
Right.
Um, and that's where my issue is with this. Even the Tesla side, any humanoid robot, it's like we're just saying, "Hey, look how cool! I made something that looks like a human." But ultimately, it doesn't make much sense to me from a business perspective. So again, from a theme and a trend, I love it. I'm going to be bullish because obviously the market's bullish, but I do think you have to pursue this with caution. You have to be, from a long-term investor perspective, I think robotics and specific expert systems are a better bet than humanoid robots.
Yeah.
We would have had that. So I'm just kind of curious and comparing it to something. We all grew up and we probably saw Mr. Gadget, I think was his name, right?
Inspector
Go
Gadget.
Gadget arms, go
Yeah.
Gadget
Inspector
legs,
Gadget.
go
Yeah.
Gadget, like
Yeah.
toolkit, right? And I think this is why maybe it's been fashioned in the form of a human, because you know what, a human is not purposely shaped to vacuum a room, but we have the Roomba or the iRobot, right? A human is not perfectly shaped to play basketball, but a few of us are really good at it, not so much me. But when you put all those tasks together, you start to escape the Internet of Things where things are just purpose built and now you need 20 robots, to something that is built to be able to do those 20 tasks, not quite as well as those individual 20 products, but it can at least get them all done. So this is where I fully agree with you guys that maybe general robotics could be better for a lot of these things. But if I'm looking at my kitchen right now, I've got a coffee machine, I've got the mixer, I've got all these different products that do slightly different things. But you know what? If we put them all together, there's got to be something there.
Yeah.
And then it knows you better as well with all of the understanding of language and everything there. So I think that's why we're looking at 2040 and we're not looking at 2028.
Yeah.
We're looking pretty far ahead on this.
But looking
ahead,
at the
Evan.
business side, though, just let's talk about that for a second. Yeah, it kind of goes back to the conversation that we've talked about before about large language models versus small language models and purpose-built language models. I don't imagine, if you're a business, I don't understand why you would pay a premium for a robot that can do a substantial number of things that do not impact your business. You would rather pay the least amount of money to get the robot that can accomplish the specific task that you need, and exclusively that task for the longest period of time for the lowest amount of money. And so when you're talking about whatever 16 billion or whatever 8 billion 10 billion robots, like, it doesn't make that are humanoids, it doesn't make a lot of sense, because I can feel pretty confident that, like, most people that are running businesses want the least expensive device, and they're not going to want to pay a premium for something that can juggle and also do accounting. Like, they just want the thing that does the one thing it needs to do.
Yeah, but we've seen it before. So I was hearing this stat earlier. Henry Ford was building cars for several $1,000s when people were still making like $2 per day, right? Where does that math add up? So he came in and changed that dynamic. Or sorry, his predecessors were making cars that were many thousands when people were making a couple bucks. He changed the dynamic, and now there are probably just as many cars as people in the U.S. So where's that upper limit? And I think this could be not quite that, but it's going to be down that angle, and you're going to find those uses that are easier first. So elderly care facilities, airports. Like if you fly into Japan, you're going to bump into a robot at the airport, and it's going
Right.
to be like, "Are you lost?"
Yeah.
It'll size you up and be
Well,
like, "What language you want?"
yeah. So
But
this guy, to
service
Nick,
type things, yeah,
yes, Nick. To your point, though. To your point, not to cut you off, but to your point, the CEO of Figure was basically saying like, look, there's a lot of like really dangerous jobs out there, or like dirty jobs, right? That like people just don't really want to do those jobs. So there's high turnover in those jobs. Like robots would be great to fill those roles, right? But look, I would offer this just to, like, because I want to move to the next topic. I just like my parting thought on this is becoming clear. There's so much capital going into these humanoid robots, right? And other types of robotics too. Like to me, this is if I'm thinking like long-term investing trends, this is an investing trend, right? Like there's definitely going to be a
yes,
lot more robots in our lives that are going to, and now powered by AI, those robots are going to be able to do a lot more than they have in the past. Like I think we've been used to kind of like dumb machines, you know what I mean? From in our lifetimes to date. But I think maybe from this point forward, we're going to have much more smarter machines, uh, helping us out with whatever we're doing, right? And that could be, I think, super interesting. And I got a sense, as we've always discussed, there's going to be some new companies that haven't even started or maybe really early that are going to be very, very big robotics companies, right? And I wouldn't be surprised to see robotics companies being in like the top 50 of the S&P 500. Just like you have car companies that are in the top 50 of this, or maybe even car companies shift into robotics. I don't know, right? But this is the kind of stuff that I think it's an emerging trend. I think some of this stuff's gonna stick. But okay, let's talk Stripe real quick. So Stripe announced they're doing a share buyback. Literally, I'm calling it a share buyback. They called it an employee tender, but they're using their own money to buy back the shares, right? So they're doing a share buyback, but it's only from their own employees. It's at that $70 billion round that Sequoia did it at. But Nick, maybe real quick, like I think Stripe, not to put you on the spot, man, but I think Stripe's trading up in the secondary, right? Like I think the last I looked, my numbers that I put together had I think it like in the 80s, in the 80 billion, 85 billion range, right? I'm not
oh
sure what
yeah,
you guys had internally,
we,
but good.
we're right, yeah, mid 80s right now.
Yeah, so that's much different than 70 billion, right? But I guess maybe the question I want to pose to everybody, and perhaps Clint, you could kick us off. Like, this is wild, man. These companies are so big and they're throwing off so much cash. They're doing share buybacks. Like ByteDance did a share buyback, right? This is not like venture back early stage company stuff. This is like public company stuff where you start doing share buybacks. Like when you see this from a company, what do you think? What are you thinking about in kind of the pre-IPO stock space? They're doing share buyback.
Yeah, it's a mature organization, right? That's the first thing that comes to mind. Also, from a public versus private stock market perspective, because companies are staying private a lot longer, they're starting to demonstrate public market type behavior, and it's nice to see it getting rewarded by shareholders in a similar fashion, whether it be a valuation increase, trading in the secondary, et cetera. But it's really important for these organizations, if they are generating and throwing off a lot of cash, to be able to, at certain points in their life cycle, offer up liquidity to their employees and to shareholders. And I think it's a good thing. I love seeing it now, right? I mean, buybacks, shareholder yield is positively correlated with returns and quality. And so I think it also is a testament to the quality of the business when you can see a company do this successfully, not doing it in a gimmick fashion.
Right, right. So Evan, I mean, these guys, 85 billion, call it 85 billion in the secondary market, current market valuation to a $70 billion kind of internal valuation. Do you like the company at 85? Like what do you think? Would you be a buyer kind of at an $85 billion mark for Stripe?
You know what? I probably am. And I agree with both the points that Clint and Nick made. And when I heard this originally, or when you proposed to us, the first thing I thought about was talent. And look, Stripe has historically been known as an engineering first or an engineering forward business and a company. And look, they're operating in the valley where there's Google, there's OpenAI, there's a lot of companies that are chasing a lot of really big, ambitious projects. I think that if you're the CEO of Stripe or the leadership of Stripe, and you want to figure out a way to incentivize your talent, which you have already curated over the last decade, to stay with you and help you build the next big thing, This is
Right.
the best way to do that. And they are
Yeah.
rewarding their employees the same way that Google and OpenAI and Facebook or Meta
Mm,
has in the past. And so I think this is really smart. And what they're demonstrating is that if you're a really great software engineer and you have the opportunity to go work at any of the big technology companies, you could choose Stripe and you will find liquidity. And that's
yeah.
a big selling point. And that, to me, that makes me want to invest around 80 to 85 because it means that they're investing in their talent, which means that they're going to be
Sure.
building something bigger. And I think
Fair
they've got a
point.
great moat. I'm a big fan of the product. At the time, look, none of this is investment advice, but I think that they're an
Yeah.
awesome company. Probably one of my
Yeah.
favorites in the Valley.
No, they certainly have a really interesting. But so Nick, these guys like two years ago, they really took one on the chin because they did a hurry up like $6 billion raise in like a very short period of time to really address some employee stock option issues that they were having. Like a lot of people were kind of terming out of their employee stock options, and they had to reset that pool a little bit. They had a big tax bill, and they had to do some other stuff. But now that they're past that, right, it looks like they're starting to do these like structured tender offerings, like we're seeing a lot of companies do in the pre-IPO stock space. I
Right.
think both Clint and Nick both highlight, or Evan both highlighted like the benefits of that. But I mean, are you seeing like what other companies are you seeing? Perhaps anything that comes off the top of your head? Like I know OpenAI is doing it, and there's some other companies. But do you like these structured kind of tenders? Do you think they're smart? Is it good for kind of maybe the pre-IPO stock
I
market in general? Like, what are your thoughts there?
sure. I mean, I hate to just echo what's been said, but I do think there's a big benefit. Just to bring a question into it, I think there was a cap though. Is that right? So it's
Yeah, they
only
were
up to
a couple
50K
thousand.
or
Yeah,
something like.
per employee.
Yeah.
That's right. That's right.
So
All right. Well, then maybe let
so
me
so I
try.
think
Let me ask you this: different question, maybe slightly different question. Stripe isn't going to go public anytime soon. They keep doing these tenders. That's my opinion. So is that good? Like now that these companies are, because you're looking across all these companies, right, Nick? So now that a lot of these companies are starting to do these like structured tenders, like what's the motivation to go public, right? If they kind of have easy access to capital, do you think that it's going to allow these folks to stay private even for longer?
I think it's going to satiate the demands of the internal employees. Evan hit on something good about attracting talent to know that there's
Mhm.
liquidity. So if you've got Stripe that offers liquidity and Stripe 2.0 that doesn't offer liquidity, guess what?
Mhm.
You're probably going to go to the one that has the tenders on a regular basis. And we know that certain institutions are setting up just catering to the firms that want to run these tenders and making it even more efficient now.
Right.
So like
Right.
that
Right.
process that's been set up, you just create it and go perpetually. In this case, I think it's kind of cool because they did put a cap on it. You know, you can't just like if you're an early employee, you've been around there and you were abutting the tax burden, and now you're just like, oh, let me sell more. You are kind of stuck to get out that 50 grand to go buy a cool car, but not a down payment on a house. You know,
Right. Yeah. Fair.
and I think that either sends a good message to investors that, you know what, we're going to afford this for our employees, whether it's every 6 months or every year or whatever that cadence might be. But we know our capital isn't best put to use buying back our own employees' shares. We're still going to invest in X, Y, and Z to promote the
Yeah.
business. So I think it's starting to show that nice delicate balance. If they do it with such a regular cadence, I don't think that should particularly augment when they choose to go public. You know, when are they going to do that last hurrah, get that big injection, and go for a seismic change, right?
Right. Got it. Got it. Yeah. I mean, it's going to be interesting to see what happens. These structure, first of all, as a pre-IPO stock investor, I love these structured tenders, right? I mean, it gives a really solid institutional price for the company. So really good on price discovery. There's usually a lot more investors out in the market. I mean, in this case, Stripe's buying, it's a buyback, so that there's no new investors in the mix there, but it just adds a lot of liquidity into the market. And if you know it's coming every 6 months, every year, that helps a lot, like just clear trades, right? And get transactions done. So I love it for that. I mean, I think it's interesting. I don't know if I'm totally bought in or made a decision on how this will actually impact IPOs. But I mean, I think it's fair to say that one of the reasons you would want to go public is access to capital. But there seems to be a lot of capital in the private markets now. So that reason, I think, is frankly off the table. I mean, CFOs I was talking with a guy the other day. I mean, I don't even think these CFOs are going out and doing roadshows. They just call a bunch of venture capital firms and they go out and do the roadshows to pull in the money for investors. So if you can just snap your finger and say, I need $750 million in 3 months time, and the money just shows up. And I know it's work to do that, but you're going to have to do, if you go public, it's even more work to do that kind of stuff, right? For a finance team. So I don't know, it's really interesting, I think, to see what the dynamic of kind of this like more mature, institutionalized pre-IPO stock market is going to have on the IPO cycle.
Hey,
Go ahead,
Aaron.
Evan.
So
Go
if
ahead.
they're investor, if you were running an SPV for Stripe at, let's say, whatever, 70 or $80 billion, what would you be telling potential investors in terms of the timeline for liquidity and the potential return opportunity and the, like the IRR? Is this the sort of
Yes.
thing that like you're holding for 2 years, 5 years? How do you
Yeah.
think about that?
So, I mean, what I've been telling folks now, because they ask me that question, as you can imagine, as I raise capital for my funds. I mean, and it's not just Stripe, it's like any company. I tell them, like, look, first of all, if you do this, you got to feel comfortable about being in for 5 to 10 years, right? On any company. And it's liquid. Like if it's liquid now, it's only going to get more liquid in the future. I can't really see that changing as there's more investors in kind of SPVs or people that want to participate into this company. I don't see the investor pool and liquidity shrinking, right? So if anything, you get in now, we can always get out in the secondary market too at some point in the future. All right. So to me, that's kind of how I deal with it, Evan. Like, I don't think it's really like, hey, you're going to have to buy. And the only way we can get liquidity is through an IPO. I think we're buying in the secondary market. We can sell in the secondary market. But that kind of begs the question to like my investors, like, well, who's deciding when we sell? Right? Like, are you going to make some magical decision, Aaron? I'm like, hey, when we're going to sell. And I usually, my response to that is no. We have like kind of a very structured liquidity option timetable. And because I'm a passive investor at my core, right? So when that happens, you can either sell or not sell, but it's coming. And if you want to stay in, you're staying in for another big chunk of time, right? And then you can decide to get out again if an IPO hasn't happened yet. So yeah, to me, I think maybe a more direct answer is I think there's liquidity in the secondary market. So you don't have to wait for them to go public. You can just get out if you feel like, Stripe doubles and that's enough for you, and you can just sell in the secondary, right?
Well,
But
I'm just more
Evan,
thinking about the return multiple. Sorry, go ahead, Nick. What were you going to say?
yeah, just because I think I know where you're also going to head with this, and if you're not, even better, more to chat through. But Aaron's always been really thoughtful on this podcast about his time horizons, right? Where that if you're looking for, you're going to be in for 5 years, but it could be extended and so on. But you really want to think about you're investing in a vintage, right? So you're investing in this vintage, and then at some point, halfway through the expected duration of it, you put a little more capital in the next vintage, might be 2 or
Smart.
2.5 years out. And
Right.
then by the end of that 5-year time horizon, you're probably going to have an exit, at which time, if you're very happy with your investment, you reinvest into the next. So you're constantly having this step function. If you're just listening, I'm stepping my hands up, right? Putting boxes in the air. But that's probably the most thoughtful way to do it because it's getting away from market timing, and that's where Aaron's kind of passive ideology comes to play.
Yeah. But
Makes
Evan,
sense.
I would say this though. I think if your point was like, well, what kind of multiple could you get for Stripe? I mean, I don't think Stripe's one of the. First of all, I love that business. Okay, but Stripe at like an $85 billion valuation. I mean, what is that? A 3x, a 4x at best, right? At best. And and really the play is like how I would say I would offer for Stripe. It's how much market share is online buying gonna take from kind of in store, right? So if you kind of look at that mix, it's still a lot of buying that happens, quote unquote offline. It's like how much of that's going to continue to eat. I think to me that's more of a demographic shift thing. So I think older folks, right? As time just moves on, I think older folks are used to doing what they do. I still know people who sit down at the coffee table and pay their bills with a physical check. There's still people that like to get in their car and drive to the grocery store or drive to the bank and do their banking. So like there's a segment of the population, I think globally, that just operates in a certain way habitually. And I think over time that will change. So I think we'll probably end up in a place where, we're like 60, 70, 80, 90% online buying. And the difference will be kind of in person. And that's where maybe you'll see max valuation at Stripe. But that's like a 10, 15, 20 year thing, if you want to get to that 4 or 5x. If you're looking 5 or 10 years, I think Stripe, you're probably looking at a 2x, maybe a 3x kind of best case scenario. That's what I would offer. I think that's realistic,
And
in my opinion.
just to throw the stat out there, Aaron, you're bang on. The tender offer was 3.4 times revenue.
Great.
Yeah. So I think that, but I guess I was thinking though, Nick, like that 3x from here. So like if they're an $85 billion company, 3x would put them at like a $240 billion company ish, $250 billion company, right? Like I think in maybe 5-10 years, you could expect that kind of a shift. And it's not really, I don't think Stripe will just continue to maintain market share of its online presence, and just online as a whole will continue to be a bigger piece of all consumption. Right. I think that's kind of, in my opinion, that's the play around Stripe. But okay, let's talk xAI and then we'll wrap this up, fellas. All right. So xAI launched Grok 2 like 2 weeks ago. So that's their new large language model. Again, Grok is xAI's large language business it's Elon Musk for his business. And of course, it's got a very close tie-in with X or Twitter. Right. So the big buzz, this is like 2 weeks ago now, right? Because we missed last week, fellas. But like last week, the big buzz was that it's like you can do whatever you want on this thing. There's like no filters, right? So, and they tied in like text to image. So people were making images and then ripping these things out on X. And it was pretty interesting. But it kind of drives home, and this is what I wanted to talk to you guys about. It kind of drives home the point that how is xAI different from OpenAI and Anthropic and Llama and everybody else, right? So one is the real-time data. Like I went on to Grok today and it was typing some stuff up and it was coming back with, as of like today's date, this is what the answer is. It was literally saying that in the response. It was giving me like today's date. I go to the same thing and I ask OpenAI and it's like, 4 months ago when their last data update was, right? So the real-time data I think is interesting. Obviously there's no filters. They xAI folks are saying that's accuracy. So the goal is to have the AI return the most accurate result, right? So that's there. And then of course it's a Musk business. And like Clint talks about, he's an incredible capital raise, right? The guy can raise money. And so there's almost like, I don't know if I would say unlimited capital, but it feels like that with Elon Musk. This guy can raise as much money as he needs to raise in a very short period of time. So maybe Clint, like, what do you think about xAI as what I would call like these AI platforms compared to like an OpenAI or an Anthropic, right? For what it's worth, I got them at a $25 billion secondary market valuation right now, right? What do you think, xAI?
Yeah, I think it's a bargain relative to ChatGPT. I mean, I like, number one, the real data, the real time data is really, really important. I think the data set is really important. And I think Llama, a lot of people argue that Llama is probably one of the most developed because it has those two things as well. And it's got the Facebook data. I think when you look at the value of these enterprises, it comes down to how much data they have that they can continue to learn from. And I think when you think of xAI with the supposed Tesla partnership, the X platform, it's an amazing model for AI. And so it's probably my favorite in the space, next to that and Llama are my two favorite kind of large language models. Anthropic's going to have to be acquired, in my opinion, or do a major pivot to more B2B. And I think ChatGPT is got the first mover advantage, but xAI is going to attract a completely different user base. And so I think they've got a first mover advantage and they've got an advantage in being tied in with Microsoft. And they've got a lot of data licenses that are pretty advantageous for ChatGPT. But when I look at the valuation discrepancy between the two, my opinion, even though these valuations are astronomical, in my opinion, I think xAI is a bargain here relative to ChatGPT's valuation. So
right.
That's where I said it's. I think it's one of the best plays you can play in the actual AI, what I'd call application theme.
Okay, got it. So Evan, they did Grok 2 and then they did Grok 2 Mini. which is like a light version of that. And we're seeing a lot of the AI companies come out with these like smaller models. I think you mentioned that earlier today, right? So that there seems to be this kind of like growing space around having a smaller model and kind of the application of the smaller model, especially with businesses, because it's kind of fit for purpose. But what do you think of the prospects of xAI is supposed to be launching their API here in a couple months' time too, right? Do you think businesses will look to a Grok model and consider it in
I
line kind
mean,
of
I
with an
don't see why
OpenAI
not.
or other people? Okay.
I think that there's no reason why they shouldn't explore it. I think that there's a huge opportunity for all. I mean, look, I think the TAM for all these LLMs is very large and growing by the day. So I think that there's a lot of surface area and a lot of opportunity. Now the question is, will they capitalize on that opportunity? I think that will time will tell. I mean, I think the performance of the models that they've shipped has been incredibly
Mm,
high. And
mm,
even I think that surprised a lot of people within the space, considering the amount of capital they've invested into it and considering how many other projects Elon's working on. The model performance has been really impressive. And
mm.
to Clint's point, they've got an interesting and unique data moat, and they've got amazing distribution. They also have we've talked about here before, the business model that is somewhat separated out from just the AI model, but a subscription that includes a lot of things, the bundling, which I think is really important. But if I'm a business, I think that I'm looking, as I said before, the least expensive one that solves the problem that I'm looking for, that allows me the customization that I need. And I don't see why xAI couldn't be that model for a lot of businesses.
Okay.
So that is not saying anything about the valuation, but I just think that there's a lot of opportunity for them.
Gotcha. Okay. So Nick, it is interesting though, because right now when you buy like a subscription to X, Twitter, you get Grok, right? xAI. So there is no like xAI app, and of course when they open up the API, that's a whole different thing. But maybe just to talk about that direct to consumer business for a second. So there's a ChatGPT app, right? There's Anthropic's got their app, Claude, right? An app for Claude. There is no xAI app. Like, what do you think about that strategy? I find it fascinating, right? What do you think about that strategy where you're blending those two together, right? To distribute kind of direct to consumer. Is that smart? Do you think they should have their own xAI app? Like what's your take on that?
I think it's clever to have that be one of the differentiations. I mean, that was part of the idea behind X in the early days anyways. You want to have a super app, like you would have in China, that you guys have spoken about in the past, that can do a lot more than just, okay, pick up on the news, pick up on the fodder of what people are talking about, and then do some of what Grok will do. So for your day-to-day use, I think it's great. I think it's very cool. I do suspect that will be the large language model that could be influenced the most. So if there were things that I can toggle on and off sources, that would be really, really nice. I wonder if that's going to be part of the API, but I kind of doubt it. So I think we're coming to a world. It's just like, I mean, when you're pricing out a portfolio, you're going to have 2 or 3 sources. We're probably getting to a world with these APIs. You're going to have multi-source. You're going to have a winner with Anthropic, OpenAI, and X, all being interoperated at once.
Right.
Because I love the stats that, I mean, Evan knows really well on who's performing better than the next, and every 2 months it changes. But ultimately, what you really care about is, how does this perform on my tasks? So almost back full circle to the earlier part of this podcast. Like, do we need a vacuum or do we need a humanoid? You're definitely going to err towards the one that works best for your purpose, and that is always going to be a toss-up, and you got to test it yourselves. So buyer beware.
Yeah. This is an interesting business. I mean, I do like we've also talked to I call these AI platforms, this kind of OpenAI, Anthropic, xAI, Google, Meta, they all have kind of this AI platform. I only think there's going to be like a handful of winners here. That's kind of my opinion. I think we're going to see 3 or 4, but it's really intriguing. Like I would, if you would have asked me probably 4 or 5 months ago, I would have said it'd be like, a Google, a Meta, a Microsoft, right? Maybe,
Tesla.
and OpenAI, like those kind of companies, right? There'd be like the brand names, and then these kind of like 2 or 3 pre-IPO stocks. xAI, I think, is going to be in that mix. I will say from an investor perspective, I got a lot of people who have been calling me up and telling me that they want xAI exposure. So there's believers out there. I think there's just, and also just it's Elon Musk business. So there's some people or
Right.
anything that fellow's kind of involved in, they want to be a part of it, right? So so that's interesting. But I'm really intrigued on what these guys are going to do from a revenue perspective, right? So to Clint's point, I think from a valuation perspective, they're like really well positioned. I think they have some clear differentiators, and I'm really interested to see how they're going to do from like a business to business perspective on the revenue side. So, it'd be keeping a close eye on this company. But all right, fellas, let's end it there, man. I
Definitely.
appreciate you guys. Right? I
Thank
appreciate you
you.
guys
All
doing
right.
this.
Thank you,
Especially